Welcome to my channel. I'm the Covered Call guy, and this is my journey to creating a $120,000 per year passive income portfolio. My portfolio currently yields about $70,000 a year, just about $6,000 a month, and I will be strictly using Covered Call ETFs to reach my goal. I'm open to new ideas, so guys, leave a comment to let me know what you think I should be buying, what you think I should be researching. I'm open to all ideas and researching new things. Legal disclaimer before we start: this content is for informational and educational purposes only and is not financial advice. I am not a licensed financial advisor or tax professional. All opinions are my own and may be incorrect. Trading and investing involves risk, including loss of principal. Always do your own research and consult a licensed professional before making financial decisions. I am just some random idiot you found online, and I could be completely wrong. All right, today's topic in today's video is inspired by the ongoing government shutdown, right? The longest in U.S. history. And they just made me really think about something. I just had an epiphany, and when I went to sleep last night, and I was like, what would Warren Buffett and the great late Charlie Munger do, right? Warren Buffett said, be fearful when others are greedy and greedy when others are fearful. And right now, the government shutdown that historically is now the longest, and as of November 9th going to November 10th, it is still shut down. Airports and air flights are starting to be canceled, delayed. So a lot of things are happening, right? The SNAP benefits are being delayed right now. In court, it's being blocked. So a lot of things are happening that are unprecedented, and we've never seen this. So I just thought, how would we navigate, right? What would I do if I was investing, and what stocks would I be looking at? How would it affect certain stocks, and so which Covered Call ETF hold these stocks, right? So that's what I thought. So I compiled a my own due diligence and my own research, compiled a presentation of what I think would be a good Covered Call ETFs to buy for the recovery, because again, like Warren Buffett said, right? Be fearful when others are greedy and greedy when others are fearful. So what is being sold and dumped right now that are actually good companies, good stocks? So let's go do this together, right? So navigating government shutdown. All right, the market precedent and macro impact. Like I said, the market precedent precedent is unexpected because this has never been like this before, right? So this current administration from Trump is doing a lot of things that that has never been done before, and right now the market is actually reacting. When the government shut down, the market did not really react. It didn't really care. But now that it's going for 30 something days now, 37 to 38 days now, and no sight of both Republicans and Democrats coming together to end the government shutdown, the macro impacts are actually now starting to feel the effect, right? 42 million Americans got cut off from their EBT slash SNAP benefits. So flights are being canceled, right? So a lot of things are starting to, the snowball is getting bigger and bigger, and people are actually feeling the pinch, right? Federal workers are not getting paid. And so a lot of other companies are right now feeling the pinch also. Right, so we gotta look at the market jitters versus historical resilience. While government shutdowns inject short-term uncertainties and volatility into the stock market, history shows that major indexes tend to be resilient. Markets often brush off these events with limited lasting disruption unless the shutdown is unusually prolonged. And right now, it is the longest in history, in U.S. history. Right, the chart is just above illustrates a hypothetical major index performance around a 30-day shutdown. and the initial dip is just due to uncertainty on day 15 because there was a lot of, oh, that was going to reopen, but nope. So we're at day 30. It has kind of went back up. Going into day 35, the uncertainty is going, we're approaching day 35, and I just put it a little bit higher, and then going to day 45, which I hope not. We don't know. That's what, another 10 days maybe, and we'll be at day 45, and it's gonna be at the, I would say it will be at the highest has ever been. So historical analysis, right? We have to take all the information we can and try to compile it and try to make good guesses, right? And taking it from analysis of 22 shutdowns since 1976 shows market brush off these events, right? Because it always opens up. But however, this one is a bit different. The S&P 500 gained an average of 0.3% during the closures. Recent shutdown equal gains, while early shutdowns saw drawdowns. Recent ones coincided with gains. During the record 35-day shutdown in 2018 to 2019, the S&P rose 10.7%. Strong post-shutdown recovery, right? That's what we're looking for. The S&P gained an average of 13% in 12 months after a resolution, resulting in immediate month after average 45%. Panic selling is a strategic error, right? We're not here to sell. We are here to hold, and buy some more, right? This is how you make generational wealth. So now we have to look at which are the good stocks that we should be looking at, right? The S&P performance, key shutdowns, right? This is just a chart illustrating 1995 to 1996, 21 days, October 2013 to October 17, 2013, 17 days. These and then 2018 to January 25, 2019, which is 35 days. And then I just use as of October 1st to present, about 36 days and ongoing, right? So look at all the huge returns. We are only going to go back up when the market reopens. So right now, if a lot of people panic selling because they need the money, or they just selling to sell because they're like, oh, this is crazy, right? That's opportunity, right? They're being fearful, and we need to be greedy. All right, the 2025 data blackout, right? Data has been delayed, right? So Trump has said that until government reopens, they're not going to release any type of data, right? From the BLS, the labor statistics, the Commerce Department, cease operations, critical data, job reports, consumer price index, gross domestic product, right? It's all delayed. And if the economy was doing so well, right? If you guys can understand how Trump operates, right? He operates basically on like the ego, right? And pride. So you have to think, if the data are so good, he would have released it, right? So we have to be a little bit worried here, where the data is not good. That's where the fearful part comes out, and we'll see what is really affected and where we should be looking at to be greedy, right? Fed is flying blind, right? Investors and the data dependent Fed are left dancing in the dark, and information is starved. So they don't know what's happening, but they're just gonna go ahead and cut rates. Risk of a data bomb, a flood of delayed and poor quality data upon reopening could trigger a single sharp burst of volatility, which is good for covered call ETF investors like myself. And if you're watching, if you want, for you too. Right, the Federal Reserve is quote unquote on hold, right? They have a policy. Their policy is complicated. The data blackout is directly complicating monetary policies for a data dependent Fed that has no reliable data right now, right? An actively divided Fed. Some of the officials push for a rate cut, and while others are uneasy about cutting rates, while inflation data is missing. And then the true driver of uncertainty, this gridlock over future path of interest rates is far more potent driver of market volatility than a temporary furlough of federal workers. So it's starting to, the ticking time bomb is starting to fill up, right? Like a lot of things are starting to happen. Like I said, the snowball is getting bigger, and as it rolls down the hill, lower class and middle class and middle class will feel the pinch, and that is the majority of the population. Right, strategy, right? Should we still DCA? Should we still dollar cost average? And not financial advice, but what I would do is that I will tell myself, yes, it is advisable that I keep dollar cost averaging, right? It is a sound strategy as shutdown often creates short-term buying opportunities before an eventual market rebound, right? All of this stuff is short-term pain for a long-term gain, right? No pain, no gain. So embrace the pain because that is how you make generational wealth, and that is how your your portfolio jumps an extra 10-15% just from buying the dip, right? Validating the strategy, right? So I do have to, look and be like, is this an actual good buy, or should I wait for it to drop a little bit more? All right. um Given the market's historical resilience and temporary nature of data uncertainty, the expert consensus is to tune out the noise and stick with long-term investment plan, right? Ignore the noise and just keep doing what you're doing. Remove market timing. Dollar cost average strategy is designed for precisely such period and removes the impossible burden of timing the market, right? Never time the market, always have time in the market. And you have to capitalize on opportunity, right? By investing in a fixed amount regularly, an investor automatically buy more shares when prices are low, right? We want to buy low, not high. A shutdown induced dips should be viewed as an opportunity, not a risk. So don't be afraid of the dips. All right, and then we have to look, and then this part is we're going to research sector specific vulnerabilities because we want to see which sector is affected the most that always perform well given the reopening. So the lower the dip, the higher the rebound. Right, so sector spotlight, who feels the pinch, right? The impact is not uniform. Sectors heavily reliant on government contract and services or the most vulnerable, right? In contrast, sectors like technology and consumer discretionary are less directly affected, though they still may experience volatility from shifts in overall economic sentiment, right? So I would, in my opinion, I would say based on data, defenses takes it the worst, and then because aerospace from both private and public sector, then infrastructure, right? Technology, I would say it still does fine because everybody still need it, right? Consumer discretionary spending, right? People still gotta buy stuff. Healthcare, people are still gonna go see doctors and go to the hospital, right? You're not gonna just bleed out and not care. You're not gonna just get very dangerously sick, right, and not care, right? You're still gonna take your newborn, your infant, your kid, or the elderly, or people with health conditions. You're still gonna go to the doctor or hospital. You're still gonna get surgery, right? You still need your medicine, right? Again, this is hypothetical data and shows the average performance deviant for key sectors during a shutdown, right? Red bar indicates a negative and the green indicates a positive. The great contractor divide, right? The resilient government services, they surge, right? Like CACI International is a defense contract services, like Booz Allen. Booz Allen is a defense contractor, right? These firms do well, right? These firms operate on a long-term pre-funded consulting and support contract, right? A shutdown freezes new awards, but their existing work and revenue continues, insulating them from funding lapse. And then vulnerable, right? Defense hardware, which stays flat or goes down, right? Raytheon, and then Northam, right? They rely on steady pipeline of new multi-billion-dollar awards for jet and missiles. This pipeline is now frozen, create near-term uncertainty. Remember, near-term, right? Short-term. For the most part, they will always continue to get new contracts when the government reopens, right? So we want to look at the the short-term uncertainties for the stocks and sectors. All right, contractor stock performance. Here is just the services. As you can see, I'm not going to go over too much. Right, you can pause the video and check them out. They're well-known names. The buying opportunity and hardware, right? We got to look at the analysis thesis, right, of buy the dip. Morgan Stanley is advising clients to be buyers of tepid defense outlooks, stating shutdowns provide attractive entry points, right? Attractive entry points is where we want to be at for long-term exposure. The muted guidance play, right? The thesis is that firms will offer conservative guidance due to the shutdown, but this is always revised upwards as soon as funding is restored and delayed contracts are signed, right? And this thesis is validated during shutdown on October 21st. Lockheed raised its 2025 forecast, citing robust defense demand. And then Northam increased its 2025 EPS guidance, earnings per share. Like broader section rotation, right? Flight to safety. A lot of people always gonna go to the winners, right? A classic rotation is evident. Top performing sectors are defense and non-cyclical, which is healthcare, utilities, and consumer staples. And then the consumer pain, the laggers, right? Because they also get hit, is the consumers the laggers are directly impacted by economic freeze and loss of 1.4 million paychecks. There will be consumer discrepancies. All right, I might be saying that wrong. Energy and finance, right? But they will always rebound when the government reopens. So this is where we want to be looking at the pains, right? People always going to come back to spending. People need the energy, right? You need to drive your car, and then financials, right? I mean, banks will always recover, almost always, right? At least good banks, big banks, the big four. Like sector laggards, a deep dive, the consumer XLY, that's the ticker symbol. All right, 1.4 million workers affected, approximately 700,000 federal workers are furloughed, and another 700,000 are working without pay. Federal contractors are not guaranteed back pay, wiping out household income. We have a 73-year all-time low. The current conditions component of the University of Michigan Consumer Sentiment Survey fell to its lowest level since 2022 of June and is at a 73-year all-time low, right? Spending curtailed. This has crushed consumer confidence and directly curtailed spending on discretionary items like restaurant, retail, and travel, hitting XYL sector the hardest. So this is XYL is one thing to look at. We want to see how hard it hits. Has it rebounded in the past? Right, and then another sector that lags behind is airline and financials, right? Airline, Delta, United, right? These airlines are directly hit by government staffing shortage. The FAA is reducing traffic by 10% at 40 airports, right? 40 major airports due to staffing issues. This directly hits airline revenues, capacity, operations, right? And causing stocks like Delta and United to lag. And then the financials, right? XLF, as in these are just sample ticker symbols. These banks, like especially regional banks, are suffering second order effects. Furloughed employees may begin to miss mortgage, auto loans, and personal loans, and increasing bank provisions, right? And then the SBA loan processing is frozen, stalling a key revenue stream for regional banks. All right, so where does covered call ETFs come under, right? Because of course covered call ETFs are still under pressure. Right, the covered call ETF connection here, we got to look for income investors using CC ETFs. The impact is twofold. First, increased volatility in the underlying stock, especially in affected sectors, can fluctuate option premiums, potentially impacting how much is being distributed. Right. Second, the ETF performance is directly tied to its holding. Right. One, boom, the shutdown begins, uncertainty rises, contractor stocks experience volatility. Option premiums fluctuate with volatility, and covered call ETFs. Right, the NAV can be affected because of how much is paid or how much is not paid. All right, this chart just shows how a shutdown induced volatility in specific stocks like government contractors directly impact option premiums. Right, that the covered call ETFs rely on income. And then we had the volatility paradox, right? Core risk is complacency, right? The greatest risk is not market risk, but market complacency, right? Higher implied volatility, the IV equals higher premium, and lower IV means lower premium, right? We always want to check the VIX, right? Is it really quiet? How's it doing? Is it going up? Is it in the fear gauge, or near 16, or is it below its long-term medium, right? All of that affects the payment of our covered call ETFs. And then pressuring the field, right? Global X QYLD, for an example, right, confirms the low VIX, and that just means that it hurts the premium. So a low volatility environment is the primary risk for income stream. So we have to look at all of the data and see where is it pointing to. And then dividend stability analysis, right? Is it a contractory signal, right? QYLD is just an example. Same with XYLD. These are just examples I use. Their distribution has increased, but this reflects options sold in September roll period before the shutdown. So you guys have to be careful of that, right? We want to look at the current data during the shutdown, right? We have to use a real signal such as JEPI, which is being actively managed on a different schedule, right? It provides the first real signal. Its November payout reflecting the October shutdown is down 4.1%. So that gives you a better, more accurate idea, right? Then we have to validate the thesis, right? This validates the thesis that low volatility during shutdown will pressure future distributions for all covered call ETFs. All right, so we have to identify at-risk versus resilient ETFs, right? So at-risk covered call ETFs are the passives, right? The passive covered call ETFs will probably get hurt the most. And then we have to identify the resilient covered call ETFs, right? Active and diversified covered call ETFs will not be affected as much, right? They have a better buffer from direct shutdown impacts. And then you have to look at the active versus passive strategy. Which one would you delve in more? Which one would do better, right? Passive, such as QYLD and XYLD, right, follows a rigid passive buy right strategy, buying all stocks and writing at the money index, right? Risk one, there's no differentiation, right? Cannot react to the contractor divide. And then risk two is the upside cap, caps 100% of the upside, right? Structurally guaranteed to miss the 13% average post shutdown recovery rally. And then we have active covered call ETFs such as JEPI or DIVL. They are actively managed that use ELNs for stock picking to generate income while holding a basket of stock, right? What is the first advantage? Is stock selection, right? The managers can actively select recovery stocks. And then advantage two is option strategy. Its flexible strategy does not cap all the upside, right? We want to capture the upside for the recovery. Actionable reports and recommendations. This is just where I'm gonna start looking what I would buy, and I start compiling a list of what I would buy for the recovery. Right, holding analysis, ETF exposure, QYLD for me not good, XYLD in the middle, but I wouldn't really buy it if I had other options. And then I would probably continue to buy the dip for JEPI because it would have the best chance to perform the best. Right, government contractor exposure, right? QYLD, no. XYLD, some. And JEPI, yes. All right, strategy, my potential recovery ETF focus, right? I want to have a diversified tech, diversified in healthcare infrastructure, and broad market, right? I want to be able to not be as affected by shutdowns, but benefit from the recovery, right? I want my sector to be non-cynical and resilient. I want to benefit from delayed spending bills that pass post-shutdown, right? And I want to just capture the general market rebound. My core recommendation to myself after doing my due diligence, right? The core play would be like JEPI and DIVL, because they have such a superior strategy for specific environment, and they are designed to solve two primary challenges, right? Stock level divergence. They have active management allowing them to hold the buying opportunities, and they have recovery participation, right? I want their flexible option strategy to allow them to participate if the post shutdown recovery is a way passive 100 capped focus fund cannot, such as QYLD and XYLD, right? These funds are just capped and they're not going to recover. They don't have that strategy to. All right, my playbook, right? The premium active funds, right? JEPQ, GPIX, GPIQ, Maggie, right? These are actively premium income ETFs from JP Morgan, Goldman Sachs, and Morgan Stanley. Not Morgan Stanley. I think Maggie is from Roundhill. That would have been a mistake. That is a mistake right here. Sorry, that would be from Roundhill, I believe. The strategy actively select stocks using ELNs, right? Shutdown, low volatility, JEPI. The income is pressured by low VIX, and that would be stable. So I would buy the dip because it has good recovery potential, right? Rebound like JEPI, they do not cap the 100% upside, so they're built to capture a significant portion of rebound, right? Excellent tiers alternative to JEPI are these. And then Divil is also great from Amplified, right? Their active ETF holds 20 to 25 dividend aristocrats, and they selectively write calls in them, right? So they have a true stock picking fund, very high quality. Even if the shutdown is low volatility, income is less affected, right? As its dividend is a blend, right? They have great their strategy would allow them to have a great rebound, right? Excellent upside capture. And my verdict is that it is A tier for total return. And then we have the hybrid, right? SPY, SPY-I, QQQI, IWMI from NEOS, right? These active ETFs buy the index, sell calls, and use some of that premium to buy put spreads for tax advantage income if you have a tax advantage account. If not, it's still great. Their strategy aim for high tax efficiency every month, right? With some upside, and the shutdown doesn't really affect them. Their income is still premium dependent, so it just depends on the VIX. The rebound, right? They're not 100% capped, so they are designed to let the index run, right? That's far superior than QYLD and XYLD for a rebound. My verdict: A tier. And then QDevo and QQXT, right? They are dynamic overriders, right? These funds are from Amplify and Nuveen. They tactically, right? That's the word they use in their strategy. They tactically decide how much of the portfolio right calls on, right? From 0 to 100% based on market signal, right? Their strategy is built to be smarter than passive 100% writers, such as the QYLDs. The shutdown doesn't really affect them. The model is likely to see low volatility and reduce the percentage of call written. This lowers their income dividend but maximize their upside exposure, right? So we want that recovery, we want that growth, right? Rebound, this is what they're built for, right? By writing fewer calls, they will participate almost fully in the rebound, right? My verdict: excellent for total return. And then we have the defensive and sector plays, right? NUSI, right? Nationwide risk managed, right? This is a defensive call fund. It sells a call to buy a protective put, targeting a net zero cost for insurance. Their strategy is to protect against large losses, right? So it's a hedge, right? The shutdown, right? The put protection is wasted as the market is complacent and not crashing. So I would put this in a mid tier, right? My verdict: this is the worst fund for a rebound. It is a upside. Its upside is hard capped like QYLD. So my verdict is to avoid for rebound. This is an investor expecting a crash. And then we have XYLI, XYYF, and XYLF, right? These are the sectors cover calls, right? These are passive, 100% capped on the most beaten down sectors like industrial, consumer, and financials, right? High risk, high reward bet. Their income will be low, again depending on the VIX, and their NAV will be depressed from sector pain, right? This is a tactical trap. The 100% upside cap makes it very likely the fund misses on the big rebound. My verdict: just stick with JEPI or Divo, which are way smarter to play the sector rebound. And then we have the recovery playbook, right? The ETF tiers. My A tier would be JEPI, JEPQ, Divo, GPIX, SPY-I, QQQY. My B tier for kind of like the growth hedge would be QDevo or QQXT, and then I would avoid QYD, XYLD, NUSI, XYLI, XLYF, XYL. Oh, I'll put that together both. All right, that's a mistake, but I would avoid these, right? These funds are the wrong tool for the job. They are hard capped for the upside, right? Whereas we can go B tier tactical, right? They have dynamic overlay built for this, so they play both growth and income. And then we have the peer income, which captures both down and up, right? This plays both games. That's why this A tier. That's why I love these, and I would hold these, and I would build and dollar cost average into this, and then maybe something left over spill into this. But I would definitely avoid buying these. All right, then we ask question and answer sectors and volatility, right? Which sector shows the strongest recovery, right? The whole market recovers on average 13% in the defense and aerospace, right? Government sectors, defense leaders, right? So they will always continue. We shouldn't be worried too much about it. Ignore the noise, right? So how do shutdowns affect premiums? Well, this is dependent on the VIX, right? Logically, the implied volatility should rise, right? If the VIX is quiet, which is near 16, this suppresses option premiums and pressure dividend yields. How does consumer confidence affect retail? Of course, it's going to be negative and severe, right? If you don't have any money to spend, you're going to only be buying and paying for essentials. You're not going to be going out and buying freaking Gucci bags and LV. ETF dividends and holdings. How do shutdowns impact dividend payouts? Technically, indirectly via the VIX volatility, right? It's all about the VIX, right? A direct data point that we can use is that JEPI dividend decreased 4.1% in its November 5th payout, and that reflected the shutdown. What percentage of contractors are in these CCE ETFs, right? QYLD 0, XYLD about 1 or 2%, JEPI about 2%. Which covered call ETFs had the highest defense allocations? I'll say no. Covered call ETF is focused on defense. Of the major ones, JEPI has the most significant and active exposure to key hardware stocks like Raytheon, Northam. Strategy and rebound, right? How long until the market rebounds? Honestly, nobody really knows, but I just put the rebounds often immediate and can be before the resolution. Again, I just put that there because we never really know. But I'm using historical data. Market always rebounds. I just don't know when, but it will always rebound, right? After the last 3 major shutdowns, the S&P rose 4% to 5% in the first month after reopening. So I'm just going based on historical data. How effective is covered call hedging in a shutdown? For the most part, not really, right? Premiums offer a limited buffer against minor dips. The real risk is the upside cap, right? You don't want to be capped upside. Do active versus passive ETF write options differently? Yes, right? Passive QRDO, active JEPI Divo. And that is the true value in active. Managers can tactically adjust strike price timing and target. Macro impacts, right? How does this affect bond ETFs versus covered call ETFs, right? Well, it creates a flight to safety. People are going to start going back to U.S. Treasuries and fixed income, right? This is the opposite of covered call ETFs, whose yields suffer from correlating drop in VIX. So it just depends on how scared you are, right? But don't be scared, right? When others are being scared, you buy. How does this influence Fed policy? I would say profoundly, right? The data blackout right now creates kind of like a stalemate, and it paralyzed the Fed. They don't really know what to do. The policy is uncertain, but they have rate cuts scheduled, so I guess they're still going with rate cuts. How does delayed data affect volatility? Well, short term, of course, it's gonna always be lowered by removing catalysts, and then medium term, or expect to amplify the VIX upon reopening as the data bomb forces a rapid reassessment of the economy. Right, my key findings, right? So primary impact is the data blackout, the volatility paradox, where it's uncertainty suppress the VIX, which is going to directly pressure the option premiums, which affects our payout. And then the dollar cost strategy, right? Just dollar cost average. Don't worry about the noise, right? Too much. Just put on your headphones and ignore the noise. Keep doing what you're doing. All right, sector and ETF analysis, right? We have contractor divergence. We talked about that. We talked about passive and active ETFs, and my actionable recommendation to myself would be to look into JEPI, because it is one of the most optimal in this case. And if I want to keep dollar cost averaging, or just put a lot into JEPI to see if it would rebound and recover much better off than my other covered call ETFs. Guys, stay informed. Thank you for watching my video. Like, comment, subscribe for more market analysis. This was mine, right? My thoughts came up on what with the government shutdown, and it feels like I would still dollar cost average. I would go ahead and not be scared, right? Government shutdown, even if it continues, right, it will eventually reopen. And when it does, if you guys have bought the dip like what I'm doing, you guys will have a great rebound. Your total return will look amazing. Guys, remember, always do your own due diligence. I could be wrong, and if I am wrong, please leave me a comment. Other than that, thank you for staying throughout the video and watching it, and stay tuned on my journey. Thank you.